America had no credit cards until 1950. Think about that for a second. No swiping, no tapping, no little piece of plastic that lets you walk into a store with empty pockets and walk out with a couch, a television, or a plane ticket. For the first 170 plus years of this country's existence, the credit card simply did not exist. And yet somehow, Americans were still buying things they couldn't afford. They were furnishing homes they hadn't saved up for, driving cars they hadn't paid off, and burying themselves in debt in ways that would look eerily familiar to anyone holding a credit card statement today. So here's the question that most people never stop to ask. If the credit card wasn't invented until the middle of the 20th century, what on earth were people using for the century and a half before that? Because the honest answer is not cash. The honest answer is that Americans built an entire hidden financial system, stranger and more varied than almost anyone realizes, made up of tokens and ledgers and handshake deals and predatory lenders and one lawyer's clever idea to sell sewing machines. A system that, piece by piece, invented almost everything we now associate with modern credit, decades before anyone thought to put it on a piece of plastic. Most people assume the story of American consumer credit begins with a wallet-related mishap at a New York restaurant in 1950. And we will absolutely get to that story because it's one of the strangest and most revealing episodes in the whole history of money. But if you start the story there, you're starting in the middle. The truth is that the credit card wasn't a beginning. It was closer to an ending. The final piece of technology bolted onto a financial machine that Americans had already been building, tinkering with, and getting trapped inside of for well over 100 years. So let's go back and find out how people actually bought things they couldn't afford, long before anyone handed them a card to do it with. Let's start with a phrase that sounds almost too poetic to be historically accurate, but happens to be true. The historian Lendell Calder, who wrote one of the definitive books on this subject, put it this way: Americans have always lived in debt, he said. The Pilgrims came over on the installment plan, and he wasn't being cute. English merchants financed the Mayflower voyage, and in exchange, the Pilgrims agreed to work without profit for 7 years to pay it back. Debt is not a modern intrusion into some imagined golden age of thrift. It is baked into the American story from the very first ship. But for most of the 18th and early 19th centuries, credit in America didn't look like an institution at all. It looked like a relationship. Physical money, actual coins, was chronically scarce, especially outside the big port cities. So the way an ordinary family bought flour or tools or fabric was by walking into the local general store and asking the owner to write it down in a ledger. You'd settle up later, maybe after the harvest came in, maybe whenever you had cash on hand. This was credit built entirely on the storekeeper's personal judgment of your character, your neighbors, your reputation in the community. There was no application. There was no score. There was a man with a ledger book who knew your family, knew whether your father paid his debts, and decided on the spot whether to trust you. And Americans at the time had a very particular, almost moralistic way of thinking about this kind of borrowing. They drew a hard line between what they called productive debt and consumptive debt. Productive debt was borrowing to buy a farm, to start a business, to build something that would generate more wealth in the future. That kind of debt was respectable, even admirable. Consumptive debt, borrowing simply to satisfy your own wants and appetites, was viewed with real suspicion, sometimes outright contempt. It's a strange thing to think about now in a world where installment plans exist for concert tickets and food delivery apps, but for a long stretch of American history, going into debt just to enjoy your life was considered close to a moral failing. Even Thomas Jefferson, a man with genuinely expensive tastes, went deep into debt trying to live like European aristocracy on what was, relative to his ambitions, a hard cider budget. The distaste for consumer debt was real, but so was the appetite for the things debt could buy. Those two forces were about to collide hard, and the collision would produce the first real credit revolution in American history. The spark came from an unlikely place, not a bank, not the government, a sewing machine. In the 1850s, a company called I.M. Singer and Company had a genuinely excellent product and a genuinely serious problem. The Singer sewing machine could transform a household's economy, doing the work of hours of hand sewing in a fraction of the time. But it cost around $100, and at a time when a typical family might earn something like $500 a year, that price tag put the machine hopelessly out of reach for the very people who needed it most. Singer's business partner, a sharp lawyer named Edward Clark, looked at this problem and, in 1856, came up with a solution that would quietly reshape the American economy. He called it the hire purchase plan. A small down payment, maybe $5, followed by small monthly payments until the machine was fully paid off and truly yours. Sales roughly tripled within a year. Clark had, almost by accident, invented the modern buy now, pay later plan. And Clark didn't stop there. He also pioneered the idea of the trade-in allowance, letting customers hand over their old machine as partial payment on a new one. And then, in a move of genuinely ruthless business genius, he had those old trade-in machines destroyed so they couldn't flood the market as cheap second-hand competition. Combine the payment plan with an army of door-to-door demonstrators showing housewives exactly how the machine worked, and Singer had, without anyone quite realizing what was happening, written the playbook for how America would sell expensive household goods for the next century. By 1860, Singer was the largest sewing machine manufacturer in the world. The installment plan had arrived, and it had arrived to sell a sewing machine. Once that door was open, it didn't close. Piano makers picked up the idea. Furniture stores picked it up. By the time farm equipment manufacturers and eventually the earliest automobile companies came along, the installment plan wasn't an innovation anymore. It was simply how Americans expected to buy anything expensive. A small down payment, easy monthly terms. The genuinely radical idea, one that would have scandalized a stricter generation, was that ordinary working people didn't need to save up the full price of something before they could enjoy it. They could enjoy it now and pay for the privilege later, in small, manageable pieces. But here's the thing that the sewing machine version of this story leaves out. Formal installment plans through respectable retailers were really only available for people who already had a certain amount of stability, a steady job, an address the company could track you down at, some kind of collateral in the form of the very item you were buying, which could always be repossessed if you stopped paying. For a huge portion of the American population, especially the rural poor, recent immigrants, and industrial laborers, that kind of formal, respectable credit simply wasn't on the table. And for them, the actual mechanics of buying things they couldn't afford looked very different, and in some cases, very dark. Let's talk about the company store. If you worked in a coal mine or a lumber camp or almost any isolated industrial operation in 19th and early 20th century America, there's a real chance you weren't paid in ordinary United States currency at all. You were paid in scrip. Private tokens, usually stamped brass, zinc, or aluminum coins, or sometimes paper chits, issued by the company itself and redeemable for exactly one thing: goods at the company's store. The company that employed you also owned the only store in town, and very often owned the housing you lived in, the doctor you saw, and the church you prayed in. It was, in the most literal sense possible, a closed economy, and you were living entirely inside it. The song that immortalized this system, 16 Tons, made it famous with a single, devastating line: "I owe my soul to the company store." And that image, an entire workforce trapped in a cycle of perpetual debt to their own employer, unable to ever fully pay off what they owed, unable to leave, became one of the most powerful and enduring symbols of industrial exploitation in American memory. New miners often arrived owing money before they'd even swung a pickaxe, charged in advance for their tools, their transportation to the coal field, their first month's rent. Scrip became so entrenched in some communities that it reportedly showed up in church collection plates because it was, in practice, the only currency many families ever actually held in their hands. Now here's where I want to slow down, because this is exactly the kind of place where popular history and academic history start to pull apart. and it's worth understanding both sides, honestly. Because when economic historians went back decades later and actually dug through the company ledgers, what they found complicated the legend in an interesting way. One landmark study looked at outstanding debt at a Virginia mining company across nearly 40 years, from 1910 to 1947, and found that the average outstanding debt was only around 2% of sales. Other researchers found that in competitive labor markets, company stores generally couldn't charge wildly inflated prices because nearby independent stores and rival mines kept them in check. And because a coal company desperately needed to keep its workforce, and driving miners into ruinous, inescapable debt was actually bad for business in the long run. Scrip, in this more sober telling, was less a tool of enslavement and more a mundane cash flow solution. It let a company advance pay between paydays in a remote area where hauling in enough actual currency was logistically difficult. So which version is true? Honestly, probably both, depending on where and when you're looking. Some company towns, particularly in isolated non-unionized regions with no competition and an owner willing to abuse the arrangement, absolutely did trap families in real grinding debt. Other company towns ran the system more or less fairly, and the legend of universal enslavement to the company store, as powerful and singable as it is, oversells what the historical ledgers actually show in many places. That's the kind of nuance that gets flattened out of a 3-minute folk song, but it's important because it's a reminder that the history of American credit isn't one clean story of villains and victims. It's dozens of overlapping systems, some fair, some brutal, often existing at the very same time in the very same country. And for the many Americans who weren't miners tied to a company town, but were simply poor, urban, and cut off from respectable banking, there was another entire economy of borrowing waiting for them. The pawn shop, where you could hand over a watch or a ring for quick cash and a ticking clock to buy it back. And, far more dangerous, the loan shark. Small, unlicensed, often brutally predatory lenders who filled the gap left by a banking system that, for most of American history, considered the ordinary working person simply not worth the risk. Interest rates from loan sharks could run into the hundreds of percent annually. People borrowed from them out of genuine desperation, medical bills, rent, a bad month, and many never fully escaped the hole. This gap, the fact that a perfectly honest employed workman with no criminal record and a steady paycheck could not get a small legitimate loan from any bank in America, troubled a Virginia lawyer named Arthur Morris so much that in 1910 he decided to do something about it. He opened a small institution in Norfolk called the Fidelity Savings and Trust Company, built around a lending model that came to be known as the Morris Plan. Borrowers needed character references, 2 people willing to vouch for them, and they repaid their loans through structured weekly installments. It sounds almost quaint today, but at the time it was genuinely radical. It was one of the first serious attempts to build formal, legitimate banking specifically for people the rest of the financial system had simply written off. The idea spread fast. Within a handful of years, Morris Plan banks had opened in over 100 cities across the country, making well over 1 million small loans and proving, decisively, that lending to ordinary working Americans could be both humane and profitable. It helped convince larger, more conservative banks that this so-called small loan business wasn't beneath them after all. In many ways, it was the beginning of consumer banking as we understand it today. Meanwhile, in the cities, a completely different kind of credit was taking shape, one aimed not at the working poor, but at the comfortably affluent. The department store charge account. If you were a trusted, well-off customer at a major store, you could simply have your purchases added to a running account and settled up at the end of the month, with no interest at all. It was less a loan than a courtesy, a mark of status extended to people the store already knew and trusted. And to speed up the bookkeeping side of all this, in 1928, a company began issuing something called the Charga-Plate. Picture a small rectangle of embossed sheet metal about the size of a military dog tag, stamped with your name, your city, your state. When you made a purchase, the clerk would lay your plate into a mechanical imprinter, lay a paper charge slip on top, and press an inked ribbon across it, transferring your information onto the receipt in one motion. It wasn't a credit card in the way we understand the phrase today. It couldn't be used at a competing store. In some cases, the store itself kept the plate on file rather than letting you carry it home. But structurally, mechanically, it was doing exactly what a modern credit card terminal does. Identify the customer, record the purchase, generate a bill. The metal dog tag in a department store filing cabinet was, quietly, the great-grandfather of the card in your wallet. And there's one more mail order chapter in this story that deserves real credit, because it's easy to overlook just how enormous its reach was. Sears, Roebuck and Company. By the early 20th century, Sears wasn't just a retailer. It was practically the only retailer for millions of rural Americans, families living far from any real city, for whom the enormous Sears catalog was their entire connection to the modern consumer economy. And Sears extended credit deep into rural America in ways that shaped daily life in the countryside for generations, letting families order everything from farm equipment to furniture to, eventually, entire prefabricated houses shipped by rail and paid off over time. For a farm family in Kansas or Kentucky with no local bank willing to look twice at them, a Sears catalog and a payment book might be the single most important financial instrument they owned. Then came the automobile, and with it, the single biggest transformation in the entire history of American consumer debt. A car was, for most families, by far the most expensive thing they had ever considered buying, and there was no way most people could simply save up the full price in cash. General Motors understood this before almost anyone, and in 1919 it created a dedicated financing arm called the General Motors Acceptance Corporation, GMAC, specifically to lend people the money to buy GM cars. The typical arrangement required something like a 35% down payment, with the rest financed over about a year. And this is where you start to see the moral argument about consumptive debt finally, decisively losing. Henry Ford, famously conservative in his personal values, looked at this arrangement with real suspicion, holding on to older ideas that financing frivolous consumer purchases through debt was simply not a wholesome way to run a business or a household. General Motors disagreed, and General Motors won. Buying a car on time, as the phrase went, became not just acceptable, but expected. And GM's willingness to embrace consumer financing was a major reason it overtook Ford as the largest automaker in America. The lesson, learned by every industry that followed, was blunt and permanent. Whoever makes it easiest to buy the product wins the market, and the friction of "I don't have the cash today" was the single biggest thing standing between a customer and a sale. By the 1920s, this entire patchwork of financing tools, installment plans, charge accounts, Morris Plan personal loans, auto credit had exploded into something recognizably like a modern consumer credit economy. And then, in 1929, the Wall Street crash hit, and a quarter of the American workforce found itself out of a job almost overnight. You might expect that a financial catastrophe of that scale would have killed consumer credit outright. Instead, in a strange twist, it often became one of the only lifelines families had left. When cash simply wasn't there, installment plans and small personal loans were sometimes the only safe, legitimate way for a family to keep food on the table and the lights on, spreading an impossible lump sum cost into pieces small enough to survive month to month. The Depression didn't destroy the culture of buying on credit. In many households, it deepened the country's dependence on it. So by the time we finally arrive at the middle of the 20th century, the honest picture of American consumer credit looks nothing like the empty, cash-only world the no credit cards until 1950 framing might suggest. It looks like a sprawling, uneven, often unfair, occasionally exploitative, but genuinely functioning financial ecosystem. Store ledgers built on personal trust, sewing machine installment plans, company scrip and the real contested legacy of the company store, pawnshops and loan sharks for the truly desperate. Morris Plan banks built specifically to serve the ordinary worker. Department store charge accounts for the comfortable. Metal Charga-Plates quietly doing the job a plastic card would later do. Sears catalogs bringing credit to the literal edge of the American frontier. and auto loans that had already taught an entire generation that debt wasn't shameful. It was simply how modern life worked. Which brings us finally to the story most people think of as the actual beginning. And it's worth telling properly because the popular version of it turns out to be itself a myth. You've probably heard some version of this. In 1949, a New York businessman named Frank McNamara was out to dinner with clients at a Manhattan restaurant called Major's Cabin Grill. When the check arrived, he reached for his wallet and discovered, to his horror, that he'd left it at home. His wife had to be called and had to drive across the city to bail him out with cash while his dinner guests looked on. Mortified, McNamara supposedly resolved on the spot that he would never let this happen to him again, and the idea for a universal charge card was born on the drive home. It's a wonderful story, it's specific, it's embarrassing, it's exactly the kind of tidy origin myth that makes for great marketing copy, and according to the man who actually ran the public relations for Diners Club at the time, a longtime employee named Matty Simmons, it never happened. The whole forgotten wallet story, confirmed as fabricated only after Simmons' death when a friend published what he knew, was invented as a piece of brand storytelling, which honestly makes a certain kind of sense if you think about it for even a moment. If a universal charge card had already existed anywhere in the world at that point, wouldn't a savvy, well-connected businessman have already had one sitting in that same wallet he forgot? The real story is considerably less dramatic and honestly more interesting because it's a story about a genuine gap in the market rather than a personal humiliation. Frank McNamara ate lunch at Major's Cabin Grill nearly every day for work. He and his partners, including a lawyer named Ralph Schneider, had been developing the idea of a card that could be used across multiple restaurants around New York City with a single monthly bill instead of dozens of separate tabs for some time. It was almost inevitable that his own regular lunch spot would become the first restaurant to actually accept it. And on February 8th, 1950, that's exactly what happened. Diners Club International launched, backed by about $1.5 million in startup capital, and McNamara returned to Major's Cabin Grill and paid his bill with a small cardboard card. Diners Club itself would later brand this meal the First Supper, a title that leans directly into the very myth their own former press agent admitted was invented. History, it turns out, gets marketed just like everything else. But strip away the wallet story and what's left is genuinely significant. This was the first general-purpose charge card, the first card designed to work across many different merchants rather than being tied to just one store. Exactly the concept that would eventually define what we now simply call a credit card. It grew fast. Within its first year, it had thousands of card holders and dozens of participating restaurants and hotels. A rival operation launched in California offering essentially the same idea, and was quickly absorbed into the growing Diners Club network. American Express, watching all of this from the sidelines, launched its own competing charge card in 1958. The race to put a piece of plastic, or in the earliest days, cardboard, into every American wallet had officially begun, and it's the next chapter of that race in 1958. That might be the single wildest, most reckless story in this entire history, and it's one that deserves to be far more famous than it is. Bank of America, one of the largest banks in the country, wanted to launch a credit card that wasn't tied to travel and entertainment like Diners Club or American Express, but could be used for absolutely everyday purchases at absolutely everyday stores. Groceries, shoes, hardware, anything. And their solution to actually launching it was, by any modern standard, completely reckless. On September 18th, 1958, Bank of America mailed live, fully active, ready-to-use credit cards with real credit limits of several $100s to roughly 60,000 residents of Fresno, California, completely unsolicited. No application, no credit check on the individual mailing. If you had a Bank of America account and lived in the Fresno area, a working credit card simply appeared in your mailbox one day, ready to spend. This became known in the industry as the Fresno drop, and it worked spectacularly, and it also went wrong spectacularly in almost exactly equal measure. On the promotional side, it was a genuine masterstroke. By instantly creating tens of thousands of cardholders overnight, Bank of America could walk into local merchants from the Florsheim shoe store downtown to countless small shops around the city, and simply point out that there was already a massive built-in customer base ready to use this card right now. so the merchants had every incentive to sign up fast. Within months, hundreds of Fresno merchants were accepting the card, and Bank of America, worried a competitor might beat them to other cities, rapidly expanded the mass mailing strategy to Modesto, then Bakersfield, then Sacramento, San Francisco, and Los Angeles. Within about a year, more than 2 million of these unsolicited cards were circulating across California. But here's where the recklessness caught up with them. Because a live credit card mailed unsolicited to an address doesn't necessarily end up in the hands of the person it was addressed to. Cards were stolen straight out of mailboxes. Cards were mailed, by mistake, to people's pets. Cards were mailed to people who had already died. Nobody had verified anyone's actual creditworthiness before shipping out a live line of credit, and the results were exactly what you'd expect. Bank of America had projected a delinquency rate, the percentage of accounts that would fail to pay, of around 4%, roughly in line with their other consumer lending. The actual delinquency rate came in at over 22%. Fraud exploded into a genuinely new category of crime that police departments had never had to deal with before. The whole reckless experiment cost the bank somewhere in the neighborhood of $20 million in losses, an enormous sum at the time, and the executive who had championed the idea resigned under pressure less than 2 years after it launched. And yet, against every sane expectation, the underlying idea survived its own disastrous rollout. Bank of America tightened its practices, built out real collections and fraud departments, and the program, that had nearly collapsed under its own recklessness, eventually turned profitable and kept growing. That program, Bank AmeriCard, would eventually be spun off and rebranded into a card network you've absolutely heard of, Visa. A rival consortium of banks would consolidate their own competing card programs into what became MasterCard. The reckless, chaotic, occasionally fraud-riddled experiment conducted on the unsuspecting mailboxes of Fresno, California, quite literally became the foundation of the 2 largest payment networks on the planet. It was such an alarming episode, in fact, that it directly led to federal legislation, the Truth in Lending Act, which made it illegal to ever again mail a live, usable credit card to someone who hadn't asked for one, which tells you something. It took an actual documented financial disaster before the government stepped in to say that maybe, just maybe, mailing active lines of credit to random citizens and their household pets wasn't the most responsible way to build a financial system. Now, here's a part of this story that the 1950 changed everything narrative almost always leaves out entirely, and it might be the most important twist in the whole history because it reveals who this new, glamorous plastic economy was actually built for and who was quietly locked out of it. For roughly the first quarter century after that first Cardboard Diners Club card was handed over at Major's Cabin Grill, an enormous number of American adults still could not get one of these cards, or any other form of credit in their own name. If you were a married woman, banks routinely required your husband's signature on a credit application. No matter your income, no matter your job, no matter how financially responsible you were. If you were a single woman, you often needed a father, a brother, or some other male relative to co-sign, even if you were out earning him. And if a married woman was approved, the resulting credit card would frequently be issued in the format Mrs., followed by her husband's name, not her own name. Any credit history built by actually using that card accrued to him, not to her, so that if she was ever widowed or divorced, she could find herself, financially, starting completely from zero, regardless of how many years she had spent responsibly making payments. This wasn't a fringe practice at a handful of unusually old-fashioned banks. It was standard, common, and entirely legal across the United States right up until 1974, when Congress passed the Equal Credit Opportunity Act, prohibiting discrimination in lending based on sex or marital status. It's worth being precise here because even this milestone gets oversimplified sometimes. The law didn't wave a magic wand and grant women credit that had never existed at all. Some women, in some states, at some institutions, had accessed credit in their own name even earlier, going back in patches to 19th century property laws in places like New York. What the 1974 law actually did was make sex and marital status discrimination in lending illegal, and crucially, give women a real legal basis to sue when a bank turned them down for no reason but their gender. It's a genuinely sobering thing to sit with. Diners Club, American Express, and Bank AmeriCard had all already existed, already reshaped the retail landscape, already trained a generation of Americans in the habit of paying with plastic for nearly a quarter of a century before roughly half the adult population could reliably access that system on their own independent terms. So when you put the whole timeline together side by side, the real shape of this story looks almost nothing like the simple no credit cards until 1950 version we started with. What actually happened is that America spent well over a century experimenting with credit in a dozen different overlapping forms: ledgers, scrip, pawnshops, personal loans, mail order catalogs, charge accounts, metal plates, and car loans, quietly working out the fundamental architecture of a consumer credit economy piece by piece. And then, starting in 1950, all of that fragmented, hard-won architecture got condensed down onto a rectangle of cardboard, then plastic, and rolled out to the public with a speed and a recklessness, just look at Fresno, that the more cautious systems before it had never quite matched. And even then, even after the plastic card existed, access to it remained sharply unequal for decades, split along lines of gender, and, it's worth adding honestly, often along lines of race and class as well, in ways that shaped who got to build wealth through credit and who got locked out of that same system entirely. That's really what historians mean when they push back on the no credit until credit cards framing. It's not that the framing is factually false. The plastic card genuinely didn't exist before 1950. It's that the framing accidentally implies something much bigger and much less true, that Americans somehow lived without meaningful debt, without meaningful risk, without a meaningful financial architecture until a lawyer forgot his wallet at dinner. The truth is that the appetite to buy now and pay later and the systems built to serve and often exploit that appetite are about as old as America itself. The credit card didn't create American debt culture. American debt culture created the conditions that made the credit card, when it finally arrived, feel less like a revolution and more like an inevitability. And there's a genuinely useful lesson buried in all of this, one that reaches well past the history books and into your own wallet today. Every one of these older systems, the company store, the loan shark, the Morris Plan Bank, the reckless mailing of live cards to strangers and their pets, existed because of the exact same tension that defines credit card debt right now. The gap between what people can pay for today and what they want or need right now. That gap never closes. It just gets filled, generation after generation, by whatever financial technology happens to be available at the time. Ledger and trust, token and company store, cardboard and a signature, plastic and a magnetic stripe, a tap of your phone. The tool keeps changing. The very human tension underneath it, wanting something now and figuring out how to pay for it later, really hasn't changed much at all since the Pilgrims stepped off a ship they hadn't yet finished paying for. So the next time somebody tells you America had no credit before 1950, you'll know the real answer. America had plenty of credit before 1950. It just didn't come with a plastic rectangle attached. It came from a man with a ledger book who knew your family. It came from a lawyer's clever plan to sell sewing machines. It came from tokens stamped with a coal company's name. It came from a small Virginia bank built specifically for people the rest of the system had given up on. And it came, eventually and imperfectly, from a piece of cardboard handed over at a restaurant, in a story that, fittingly, turned out to be at least partly invented itself, which might be the most American detail in this entire history. Even the myth about how we started buying things we couldn't afford turned out to be something we bought into on credit. If you found this deep dive valuable, take a second to hit that like button and subscribe to the channel. It genuinely helps more than you'd think. And it's what keeps these long, carefully researched breakdowns coming. And if your own family has a story about company scrip, a Sears catalog order, or that first credit card that showed up in the mailbox, I'd love to hear it in the comments. I read every single one. Thanks for watching, and I'll see you in the next one.